All right, let's pull back the curtain and really dive into the hidden logic of our digital world. We're talking about the invisible forces that shape everything, from the apps on your phone to, the very future of work itself. We're going to see what really powers the most valuable companies on the planet.
So let's start with a number that's, well, it's kind of hard to wrap your head around. $5.7 trillion. Back in December 2020, that was the combined value of just 4 tech platforms: Alphabet, Amazon, Apple, and Facebook. That is more than the entire Euronext stock exchange. We're not just talking big here. This is a historic concentration of economic power.
And it's not just about the staggering numbers. As this report from the European Parliament points out, it's about a fundamental shift in how our whole economy works. These companies aren't just in the market anymore. For a lot of us, they are the market.
So how in the world did we get here? Well, that's what we're going to explore. We'll start by looking at these giants, our digital landlords. Then we'll see where the money to build them comes from. After that, we'll open up the investor's playbook. And finally, we'll look at the ultimate health check for any digital business.
First up, let's really get a handle on the incredible scale and impact of these platforms. You should think of them less as just companies and more like the digital infrastructure for pretty much everything we do now.
So what is a platform, really? At its core, it's pretty simple. They're just digital services that connect different groups of people. Amazon connects buyers with sellers. Google connects you with information. Uber connects riders and drivers. They've become our modern town squares, our digital marketplaces where we all meet up.
And, one of their biggest, most profound impacts has been on the nature of work itself. The rise of the gig economy, it was all powered by these platforms, and it has completely rewritten the relationship between workers and employers. This whole model just throws out the old rule book. Instead of traditional employees, you have independent contractors. Instead of a human boss looking over your shoulder, you have an algorithm managing you. And this is the crucial part. It shifts huge business risks, like, say, paying for car repairs or having a slow day with no customers, away from the company and puts them directly onto the worker. So what's the trade-off? You get flexibility, but you give up a lot of the traditional security and protections.
And because these platforms control the digital space where millions of us now work and do business, they essentially become powerful private regulators. Think about it. They set all the rules of the game, from pricing to who sees what, to who gets promoted, and even who gets kicked off the platform entirely.
But how do you even build one of these digital empires to begin with? Where does all that money come from? Well, the answer isn't on the public stock market. It's in a much more exclusive world.
It comes from something called private capital. This is the high-octane fuel for innovation. It's everything from early-stage bets by venture capitalists to late-stage buyouts by private equity firms. This is the real engine room of the tech economy.
And you got to understand, there are different kinds of fuel for different stages of a company's journey. Venture capital, or VC, that's like rocket fuel for a brand new startup. It's a super high-risk, high-reward bet on explosive growth. Private equity, or PE, is more like a high-performance tune-up for a car that's already on the road. It targets more mature companies and aims to make them more efficient and profitable.
And look, this isn't just some abstract financial theory. This stuff is being turned into actual real-world playbooks. Guides like this one, the Caribbean Fund Manager's Toolkit, are designed to spread this knowledge and empower new entrepreneurs everywhere, giving them access to the capital that builds the future. Okay, so a fund manager has the capital. How do they decide where to put it? It's definitely not just about gut feelings. There's a very methodical, very rigorous process. It's a highly structured system, almost like a funnel. It's designed to filter thousands of potential companies down to just a handful of the very best. It all starts with finding deals, then screening them, then doing this intense investigation called due diligence, and only then does it go for a final approval. But guess what? The work doesn't stop there. Because after the check is written, something called value creation begins. This is key. The investors don't just write a check and wish you luck. No way. They become active partners. They help you build a real board, they get your finances in order, they open doors to new customers, and they help you get your next round of funding. They are co-builders, not just bankers. So, all of this brings us to what might be the most fundamental question of all. With all this money flying around, all this complexity, how does anyone really know if a business is actually built to last?
I mean, is there one single core metric that can cut through all the noise, all the hype, all the headlines,
And just tell you the truth about whether a business can survive in the long run? Well, yes. Yes, there is.
It's called unit economics. This is kind of the secret formula that smart investors use to see past the hype. Forget total revenue for a minute and just focus on one single thing. One customer. One unit. How much does it cost you to get that customer? And how much money will you make from them over time? It's basically the fundamental DNA of a business.
And the golden rule here is deceptively simple. The total value you get from one customer over their entire lifetime with you, that's their lifetime value, or LTV, that number must be greater than what it costs you to get them in the door. That's the customer acquisition cost, or CAC. Simply put, you have to make more money from a customer than you spent to get them. And here is the absolute bottom line. If that simple math doesn't work, the business is a leaking bucket. You can pour millions and millions of dollars of investment in at the top, but it's just going to drain right out the bottom. Positive unit economics? That's the sign of a healthy, scalable business. Negative economics? That is a massive red flag that no amount of funding can fix in the long term.
So let's tie all of this together. What have we seen? We've seen these giant platforms that act like our digital landlords. We've seen the private capital that fuels their creation. And we've uncovered the core mathematical formula, those unit economics, that they all have to obey if they want to survive. This entire system, from the gig economy to whatever the next big thing is, it's all shaped by these forces. These platforms and their investors are incredibly powerful gatekeepers. They decide which ideas get funded and which rules we all have to live by online. And that brings us to the final, really critical question. In a world increasingly governed by platforms, who governs the governors? That's the thought I want to leave you with.